blind spots in your execution. Now we're going to talk about 3 blind spots. Blind spot number 1 is confirmation bias. We'll then talk about overconfidence bias, and lastly, present bias. Now, you've heard of all 3 of these most likely, okay? What I want to illustrate for you is some of the drawbacks to these biases, but equally how you can solve them, okay? A bias we all have. You cannot avoid a bias. Doesn't matter how intelligent you are, we all have biases. The way to mitigate the risks from biases is 1, to be aware of them. Okay, most traders aren't even aware of the biases that exist. And if they are aware of them, they completely ignore them. Okay, so the first thing is to accept you've got biases. The second thing is to do something about it. Put in place something that can mitigate the risks that come from those biases. Now, let's start off with confirmation bias. When we enter a trade, we're either long or short the market, okay? We are effectively now blind to seeing the facts that will run counter to our position. Instead, we will search for, we'll interpret, we'll favor, and we'll recall information in a way that will confirm or support the position we've taken. We'll even make up random stuff in our minds that we think supports or gives strength to our position. This bias is strong for trades that we have spent a lot of time planning and developing. The more emotionally invested you are in that trade and the more attached you are, the more incapable you'll be of seeing the truth. Okay, think of that trade that you planned for. You spent the whole weekend, you kind of really thought it through quite a lot, and you're like, these are the reasons I'm going to buy, and I'm going to take it to this target, and I'm going to look back at the last 20 times. The more invested you are and attached you are, the more incapable you'll be of seeing the truth. Okay, confirmation bias is unavoidable for everyone. You can't avoid it, but you can manage it with critical thinking skills. Okay, now the solution we adopt at Tradelo to avoid this is called strategy characterization. In other words, we accept that we got this bias called confirmation bias. I accept that when I'm long, I'm only going to see information that confirms that my long position is right. I accept that. I accept it as a weakness. So to make sure that that weakness doesn't impact me, I must put in place some form of a protocol, a practice. Okay, and the practice we use as Tradelo traders is called strategy characterization. Okay, and that's what these little cards are at the bottom, right? Think of them, and I'll explain them to you. Just think of them as objective pieces of information right in front of our eyes. Now, how it works is like this. Every time you execute a trade, you will observe specific objective pieces of information about the trade. Okay, recall previously I said to you, if you see 1,000 lots lifted at the market, that's an objective piece of information. Okay, now over time, as you execute a trade strategy more and more, you will start to understand the characteristics that allow that trade strategy to perform exactly as you expected. But you'll also start to understand what are those objective characteristics that lead the trade to fail and that don't work at all. And we call this strategy characterization. Okay, so every time you execute a trade, what you'll do is you'll characterize it as a textbook trade, in other words, that textbook pattern, or you'll characterize it as a failure pattern where it did the complete opposite of what you thought, or you'll characterize it as nuance. In other words, it showed some part of the pattern you expected, but it was different. Okay, now what you will do over time, so imagine you do 100 trades and you allocate them to textbook, nuance, and failure. And what you'll start to see over time is that certain characteristics keep popping up and cropping up in the textbook category. Some characteristics keep cropping up in the failure category. Okay, now what happens is through enough observations, you start to see these numbers. Okay, so if you see these numbers effectively, what they're showing you is that for this trade strategy, 5 times a successful trade has included an objective fact called low volume nodes. Okay, in other words, 5 times when this trade was a textbook, pure perfect trade where it had a really good upside risk reward, it showed me low volume nodes 5 times. In other words, this is a really important characteristic for this trade strategy to be successful. Okay, the opposite of that, if we look at the red ones, which are the failure ones, 4 times large orders were hitting the market in the opposite direction to the break. Now, straight away, you can see, imagine you've bought the market, okay? You've got in front of you objective facts that will ensure that you're not confirming your bias, you're confirming what you know to be true. So you'll be looking in the market saying, well, are there low volume nodes or not? Tick or cross. Are there large orders hitting the market in the opposite direction? Tick or cross. If the large orders are hitting in the opposite direction and you long, what are you going to do? You're not going to break your rules. You're not going to suffer the consequences of confirmation bias just because you're long. You're going to look at it and you say, I know this leads to this trade failing. I'm out. I'm cutting my losses and I'm out because I know that that objective piece of information typically leads the trade to fail. I cannot succumb to the confirmation bias because I'm leaning on objective facts in front of me. And that's the key to solving this problem of confirmation bias. It's having objective pieces of information in front of you so that even if you're long or short, you're not going to be sucked into or attached to that position. You're not going to lean on information that confirms that position. You're going to lean on the information that you know to be true. The next bias. Oh, that should say overconfidence bias, not confirmation bias. So the next bias is overconfidence bias, okay? You think your trade is better than the real probabilities. That's the reality for you, for me, for everybody, okay? We are natural optimists as traders. Just look at the statistics, okay? That's the best way to see how over-optimistic we are as traders or how overconfident we are, okay? We all know that most traders will fail. We all know that statistically. That's like cliche. Yet most traders will still give it a go. Most traders will come to us and be like, yeah, I'm different. I'm going to succeed. Okay, so despite the facts being right in front of your face, most of us still come into this going, I'm not going to fail. So we're natural optimists by definition. We need to be aware of this bias and we need to safeguard against its drawbacks. Okay, because we think we're better than we are, we need to have data at hand to paint us the real picture. We need someone or something to be realistic for us. More importantly, we need to make sure that when we feel invincible, that we don't take the kind of risks that can sink our ship. Okay, now very important. Like I said to you, biases are important. We have them for a reason, right? Being confident is extremely important for a speculator because it is the little intuition that allows us to sometimes put on those leverage positions that can make a year for us. Okay, so we need to be overconfident. We have to be overconfident by definition. But we need to make sure that we manage this confidence. And that's the key. Manage and mitigate. And make sure that it never will cause us harm. Now, at Tradelo, we manage this bias with automated risk. Okay, so think about it. We're all naturally optimistic. You spent the weekend preparing for that breakout trade. You know everything about it. You've done this time and time again, and you've had a really good weekend. You're full of energy. You come in on a Monday, and typically what's going to happen is your overconfidence is going to make you over-risk. Okay? The result is, if it goes wrong, you start the week off poorly. You lose confidence. You lose momentum. Now, with Tradelo, what we do is we use an automated risk system. Okay? So when you put that trade on your risk system, it tells you, you need to use 5 contracts. Okay, straight away, that overconfidence bias is being managed. Now, very important, it's not to say that we don't put on, 6 or 7 or 8 or perhaps 10 contracts. Okay, it's not to say we don't do that. But what it does do is it gives us a reference point or an anchor, because if I know that I'm supposed to do 5, and I go and do 50, I'm going to feel like a bit of an idiot thinking, well, I went 10 times what I should have. Okay, but if we do 7 or 8 or 9, in other words, we do a little bit more size, it's effectively linked to the original. In other words, there is some logic behind what we're doing, and that's the key. What happens for traders typically when they're overconfident is they don't have that anchor. They don't have that natural benchmark of normally I use 5. They just come in and go, well, I feel good. It feels right. All risk protocol goes out the back of the mind, and they end up putting on too much size. And when they get it wrong, they sink the ship. Okay, and that's the key. Like I said, it's not about squashing the bias. It's not about removing the bias. We need the bias, but we just need to manage the bias. And we do that by making sure our risk is predetermined. Finally, present bias. Okay, that time when the market's offering you 30 ticks. Okay, so imagine you've taken a breakout trade, you're on side 30 prices, and you really want to get out, even though you know that, or you have a high degree of confidence that it's going to get to 40 ticks. When you get out of that trade, that's called present bias, okay? And it creates a lot of havoc for us. Why? Instinctively, we all have a tendency to settle for a smaller present reward rather than waiting for the larger future reward when we put off when we put into a trade-off situation. Okay, so we always want to grab what we have now. We want to hold on to what we have now and not take the risk of sitting in it longer. And we don't want to take that trade-off situation. So we rather grab it now rather than waiting. Okay, we overvalue immediate rewards and we put less worth in long-term consequences. Okay, when you exit the trade for that 30-tick winner, do you ever consider how in the long run that missed opportunity could be the one thing holding you back from growing your account? Of course not. Okay, because we focus simply on the fact that we took a 30-tick winner. We get to the end of the day, we do our debrief, we go, well, I took 30 ticks, it was a good trade. But we have no consideration. We don't even take into account that that decision to get out for 30 instead of the 40 typically will always have implications in the long run. Okay, one reason why traders struggle so much with sitting in trades and holding them to target is because they get into this habit of falling prey to this bias. In other words, what happens is we take the 30 ticks. At the end of the day, we come and we do our debrief and we justify it. Well, I made the winner. I did good work getting the winner. Therefore, I don't consider that leaving those 10 ticks on the table have any consequences. I just look at it as next time I need to be more disciplined, or next time I need to show some more self-control. We never actually attach any consequence to leaving those 10 ticks on the table. And as a result, we kind of tell ourselves, you know, it's okay. And we say to ourselves, well, just keep doing that behavior because that behavior is good. Okay, not only is it good, not only is it the right thing to do, but you equally don't have to suffer and sit in your trades for longer. Okay, we reinforce what is actually a bad behavior simply because we don't think of the consequences of leaving ticks on the table. Here's an example. If I told you that you're 100% going to fail as a trader unless you start taking your trades to target, you will no longer be thinking of trades, of jumping out of those trades soon. You'll literally sit there until target, because if I told you without a certainty you are going to fail as a trader unless you do that, you're suddenly starting to take in account the longer term consequences of your decision making. Okay, and this is a very important bias, and not many traders are aware of this. They really do succumb to this, and they reinforce this bad behavior. Okay, now to solve this bias, we need a solution that reminds us of what is statistically possible for our trade strategies. Okay, and what are our predetermined targets? Now, at Tradelo, we got 3 solutions for this. Okay, the first is we have our strategy cards, and inside our strategy cards, it tells us our set of expectations. Okay, so for your trade strategies, make sure you know exactly what your intended target is before you get into that trade. That's your first guardrail. That's your first sort of, this is the minimum expectation of what you should be looking for. Okay, next, you need statistics at hand, hardcore statistics, not opinion, not maybes. You need to know what is actual data. What is the actual risk reward you can expect to see? Because if you're in that trade and you feel that bias, that present bias start to come up, and perhaps maybe you're at 1-to-1 risk reward, if you know that your trade typically takes 1.87, you're not going to be getting out for 1-to-1. You're going to sit tight and give yourself or give that trade the opportunity to get to its target. Okay. And then finally, we've got the guardian. Okay, we've got this guardian that's constantly reminding us of what to expect in our trades. What is our expected target? How many prices should we be typically targeting for that trade? Okay, so the combination of the 3 enable us to make sure that we're not getting sucked into that present bias. One final thing we do, and this is crucial, this kind of really reinforces or makes sure that traders don't reinforce a bad habit. When we answer our journals at the end of every session, okay, we are asked, what target did I intend to take? And what we typically do then is we go and compare the target we intended to take versus the target we actually took. And we put it in bright red to make sure that if you're not sitting in those trades to target, we don't reinforce it and say, well done, good job, you made a winner. No, we don't do that. We remind you that that's not the kind of behavior you want to reinforce. Next time, sit in that trade. If you expect it to get to 30 prices, stay in that trade. Okay, so it's a combination of solutions that ensure that you don't suffer as a result of this present bias. Okay, all right, so those then are our 3 biases. Now, man does not see reality as it is, but only as he perceives it, and his perception is flawed with bias. Okay, it goes without saying. It's not about getting rid of the biases. You cannot get rid of the biases. They are there naturally. We need to understand the bias, be aware of the bias, and then make sure we safeguard and mitigate the risks that come as a direct result of that bias.